If you've been studying smart money concepts, trading ICT style strategies, or you've been manually trying to navigate the chaos of the markets and you're still unsure about fair value gaps, then this is the only video that you need to watch. Not the 8 conflicting definitions that you've seen from these other YouTube videos that are out there, or a 3-minute explanation that's very vague from some random TikTok video. This is a complete breakdown of fair value gaps, inverse fair value gaps, how I personally use them to filter A-plus setups, past funded account challenges, and scale real profits. So without further ado, let's dive straight into it on this step-by-step explanation. So let's start with the basics. What is a fair value gap? Well, a fair value gap is a form of imbalance in price action. It's when price moves so aggressively in one direction that there is essentially a gap in the market, a moment where price isn't traded both ways. Now, I know this may sound like all crazy talk, but let's break it down so you can really understand what it means. Now, I want you to imagine something with me. Let's say that we are bus drivers and we drive a bus every single day on the same route, and we stop off in certain neighborhoods, we pick people up, we drive forward, we drop people off, and every single day we do this exact same route. And then one day we're driving and all of a sudden the bus takes control and it completely skips the next neighborhood and we don't go through it. You see that skipped area right there? We can imagine that to be our fair value gap. It is an imbalance, an area in price where we were completely skipped. Now, when I say skip, what you need to understand is that the market likes to be balanced. For every buy, there is a sell, and for every sell, there is a buy. You cannot have one without the other, because if you do, the market ends up being imbalanced. Hence the name imbalance, a fair value gap where only one position was offered and the other wasn't. So let me break down exactly what a fair value gap looks like to you on a theoretical level. Now, I'm no Picasso, so bear with me on the terrible drawings that you're about to see, but this is candle 1. We are in a bullish direction, and all of a sudden we get a massive expansion up. This big candle gives us this big expansion, and then we have another candle in this way. So what we can see is that between the gap of this wick down and this wick up, we have this area of inefficiency, this imbalanced price action. That means that inside of this gap right here, we were only offered buying positions. There was no sell positions offered, meaning it left the market in an imbalanced state. Only buys, no sells. Now, every time you execute a position, what you're actually doing, you're not randomly clicking a button and all of a sudden you're buying the market. When you buy the market, you need a seller to sell you that position. Now, I know we're getting a little bit technical, but I need you to stick with me. Every time you sell a position, you're not just randomly selling. Every time you sell, you need a buyer to give you those buys in order for you to take those sells. The market has to be balanced. For every buy, there is a sell. For every sell, there is a buy. And this is why we have tools that we can use, such as order books, which show us that at every price level on the chart in the market, there is going to be equal and opposite orders. For every sell, there is a buy. For every buy, there is a sell. And this is the same thing that you can see every single time at every price point. This is the exact reason why every time you log into your MetaTrader or you log into your trading terminal and you just randomly click buy or you randomly click sell, you don't have to wait around. There is always an order on the other side that you can take. Every time you buy, there is a sell waiting to be happening. Every time you sell, there is a buy waiting to happen. That's why you can instantly execute in these markets. Now, I'm getting a little bit theoretical. I may be getting ahead or over the head for a lot of you. So just stick with me. I'm just going through the theory. We're going to get onto the actual chart analysis in a minute. But we have to come back to the theoretical understanding of what an imbalance or a fair value gap is. It is simply an area of price in the chart where only one position was offered. So now if we go back to our example of my amazing drawing that I've got on the chart right here, if we flip this into a sell position, is the exact same thing in the opposite direction. So we've got a gap right here in between this wick and this wick of the third candle. This means that right here in this 3-candle formation, where this gap is in the middle, there was only sells offered. This candle only gave us the capability of having sells. This means that the market is now imbalanced because we only have sells. So in order for the market to be balanced, we need price to retrace and come back to this fair value gap, close it and offer the buy so that we've closed out and equalized and we've got equilibrium in the market. And then from there, we can continue in the pro trend direction. Now, that was a lot of words. I hope you guys are still with me. And I just want you to pay close attention to what I just said. This is a key area that price needs to come back to in order to rebalance price. Give it that equilibrium. This means that fair value gaps are not just random gaps in the chart. They are a magnet for price. These tell us two different things. That this is an area where institutions more than likely executed a position because only they have the capability to move the market in such a rapid direction where only one position is offered. And number two, it tells us that this is an area that is magnetized to price, and price more than likely will retrace back to it at some point in time in order to rebalance itself. And that is perfect for us because we can use this to our advantage. Because now we are no longer reacting emotionally. We're building a map of where price is likely to return so that we can use that as our edge so that we can take trades based off of logic, not emotions. So let's take a look at some examples on the chart really quickly so that you guys can understand exactly what I'm talking about. So right here, we have this nice fair value gap. Now, how did I see this so quickly? Well, it's simple. All we need is a 3-candle formation. Candle 1 gives us a second candle, which gives us this massive expansion. And then we have candle 3, and the third candle's wick does not touch the first candle's wick, giving us a nice gap in the market. And what happens if we slide this across to the right? Price comes back to rebalance it at a later date. And then what happens from there? Price then absolutely rockets straight to the outside because what happened when this fair value gap was left? There was an imbalance in price. Price was no longer in equilibrium because during this phase, only buys were offered. That means we're in an unstable state. Price then came back, retraced into this fair value gap to rebalance price, to offer those sells, and now that we've been balanced again, price then plummets straight into its pro trend direction. Now, this is where you can start to utilize other confluences such as market structure and liquidity to start building a framework, to start building a plan to take these A+ setups. So let's continue looking, right? We've got a bunch more fair value gaps that we can see. So we've got a fair value gap right there. And what happened when price came and tapped into it? It then tapped into it and then it started running to the downside. And again, if we go and analyze what happened right here, we've got the same 3-candle formation. We've got candle 1, candle 2, which gave us this massive expansion to the downside, and then candle 3. Now, candle 3's wick is not touching candle 1's wick, leaving this massive inefficiency in the market where only sells were offered during this period, which means we need the buy positions to rebalance price. So then when price came back into this fair value gap and it closed out that imbalance, what happened? Price then plummeted in the opposite direction, right? But there's one thing that I really want you to remember. Fair value gaps are not the holy grail. They are not a singular trading strategy by themselves. A fair value gap is just a confluence that you can add and stack with other confluences into your trading plan so that you can start to frame an A+ setup. You don't just use fair value gaps by themselves to just take a trade off of any random fair value gap because it needs to be in context of the entire market. All of these confluences are irrelevant without the entire context of the market and it being in a trading plan. So what you need to do is use fair value gaps in conjunction with the higher time frame so that you can add them as a confluence into your trading strategy. You also need to utilize things such as liquidity sweeps. And if you haven't watched my previous video on liquidity sweeps, go and do that now because that will teach you everything that you need to know about liquidity. On top of that, we need to add it into a trading plan so that when combined, a fair value gap is going to give you so much power in the market that it's going to completely change your trading. So let's actually put it all together into a trading plan so that you can actually start utilizing fair value gap in your day-to-day trading. So we're going to start off on the daily time frame. And this is what you're going to do. You're going to utilize a higher time frame to understand the direction of the market. Now, in this market, what I can see is that we had this lower low, lower high, lower low, lower high, and then we had this break of structure to the upside, indicating that the markets have now flipped from bearish to bullish. So then we've put in this higher low, higher high. So we are now in a bullish market on the daily time frame, which means I'm going to be looking for buying positions. We then drop down to a lower time frame where we can start to identify key areas of liquidity and fair value gaps in the market. So when we come over to the hourly time frame, what can we start to notice about this price action? Well, first and foremost, we can instantly notice that right here we've got this double bottom. Now, double bottom is a retail trader's perspective. However, for us as smart money traders, people who understand the market, what we understand is that this is just another form of liquidity. Now, on top of that, what else can we see? Well, we've also got a bunch of liquidity sat along the top, acting as a trend line, which again is a retail concept, but we as smart money traders understand that this is more liquidity. Now, the overall context of the market is that we are bullish. So we're looking for buying positions. So we know that at some point in time, we're going to have to come down to sweep this liquidity, and then we're going to have to push up to sweep this liquidity. So now, because we're bullish, we have to look for key areas just below this liquidity so that we can enter the position for buyers and ride it to take out this higher liquidity. So we've understood our liquidity, we've understood the higher time frame buyers. We now need to identify the fair value gap, which we're going to be looking for price to target. Well, right here, we've got this massive fair value gap, which actually got tapped into. So you're probably saying to me, yeah, but CEO has been tapped in already. What do you mean? Well, if we take a look closer, what we can see is that the fair value gap has now changed. It's no longer from here to here, but it is from here to here. So we've got this wick, and we've still got a gap between. That means that within this area, only buyers were ordered. That means that there is an imbalance in the market and we need to rebalance in order to push higher. So we can now also stack our confluences on top, because what we can see is that just above this fair value gap, we've got all of this liquidity. So our first confluence is the fair value gap. Our second confluence is the liquidity. And our third confluence is that we are in an overall bullish market. So when we zoom out, we've now identified that we've got liquidity, we've got a overall bullish market and a fair value gap that needs closing. So what we can do is we can wait for price to come down, take out this liquidity, tap into that fair value gap, then we can drop down to the lower time frames once that happens in order to identify an entry schematic, which is going to give us an entry to take price long. Now, I'm not going to go into detail about entry schematics because that's something that we can cover at a later date, but this should give you a broad and basic understanding of what a fair value gap is and how you can stack it as confluences into your trading plan so that you can start taking these A+ setups yourself. So if I play price forward, what we can see is that the exact same thing happens. Price comes down and it sweeps all of that liquidity, taps into that fair value gap, and then where do you think is going to target next? What have we now continued to build up? We've continued to build up this trendline liquidity, which means that eventually, because we are in a bullish market, we should target that liquidity. And we do so right there. All you have to understand in the market is where are the pools of liquidity and where are the imbalanced area of price, because price always moves between pools of liquidity and imbalanced price. That's simply it. So remember, price seeks balance. Fair value gaps are not a trading strategy. They are simply a confluence for you to use in order to frame up A+ setup. Use them with your rules, use them with a trading plan, and instead of being caught up in the chaos and the madness of the markets, you'll start to execute like a sniper. So if you want to learn more and you want to learn exactly how to trade and build an A+ trading plan that includes market structure, multi-time frame structure, inverse fair value gaps, entry schematics, everything, then I really need you to click that link down in the description and book your Gemini trading strategy call. We'll audit your current trading, see all of the blind spots that we can find, and build it into a systemized trading strategy. And if it fits, we're going to help you build it into a trading system through the Gemini Protocol. So I hope you guys enjoyed this video, and if you did, then don't forget to leave a like, comment, and subscribe. But on that note, I'll catch you guys in the next video.